You open your candlestick chart, the price is dropping, so you spot a perfect reversal. You enter your trade, then it flips. Does this sound familiar? Believe it or not, this isn't just bad luck, it's because you were reading shapes instead of figuring out who controls the market. In the next few minutes, I will share with you 5 powerful candlesticks patterns for beginners that actually matter in candlestick trading. You will learn exactly what each one reveals about the battle between buyers and sellers and find out how random shapes can turn into clever setups. Stick around for the 5th one because most beginners completely misread it and pay the price. Before we get into patterns, I want to ask you one question. It's a question you should ask yourself every time you look at a candlestick. Who is in control right now and is it about to change? That's it. Every candlestick pattern is just a visual answer to that question. Some patterns tell you that buyers just took over, some show that sellers are losing grip. Some say that nobody's in control, so it's best to wait. Think of candlesticks patterns like footprints. A footprint alone tells you someone walked here, but the direction, the depth, the spacing tell you where they are going and how fast. Patterns work in a similar way. If you're excited about this topic as much as I am, give this video a like and let's dive deeper into the special 5. The first pattern is the bullish engulfing. On your chart, you see a small red candle followed by a larger green one that completely takes it over. Remember, you are looking for green domination and not just slightly larger shape. That's signal that buyers are stepping in and wiping out the selling pressure. Here's what most people get wrong about this setup. They trade the shape and not the situation. Open your chart right now and scroll back. Find one bullish engulfing candle and ask yourself this question. Was price clearly moving before the dominant green candle popped up? Or was it just moving sideways? Because if sellers weren't in control, buyers didn't take anything over. The next candle tells you everything. If price keeps moving up, buyers have actually taken control and the move is likely to continue. So it might be a good time to enter an up or a buy trade. If it stalls or pulls back immediately, that engulfing was just noise, so you should probably hold off. Next up is the bullish kicker. This one is more aggressive compared to the other ones I'm going to show you. You see a red candle close, then the very next candle gaps open higher above the red candle close and goes strongly upward with no overlap between the two candles. No hesitation or gradual shift, just a sudden market surprise. Remember the grand question, who is in control and did that change? This pattern isn't a slow reversal. It's an instant shift between the close of the red candle and the open of the green candle. The market sentiment flipped completely. That happens when a key price level gets rejected hard. When momentum shifts fast and buyers respond aggressively. The trap here is hesitation. Most traders see the gap and wait for price to pull back before entering. With this pattern, that reversal often doesn't come at all, or happens briefly before the next one continues. What you need to figure out is the gap holding? And if price tries to fill the gap and fails, that move is likely real. If it immediately reverses back into the gap, that pattern isn't holding, so you need to be cautious. Now a softer kind of candlestick pattern that we often come across and easily miss. Here's the structure. A red candle close, then a green candle opens below the red candle's close and pushes back up, closing above the midpoint of the red candle. Not fully engulfing it, just piercing into the lower half. Back to our most important question. Who is in control and did that change? With a bullish engulfing, buyers fully overpowered sellers in one candle. The piercing line is telling you something different. Selling pressure is still present, but buyers are now challenging it. This is an interruption signal and not a reversal. And this is a very important distinction to make. If you treat a piercing line like a full reversal and enter aggressively, you will often get caught in the bread itself and if sellers take over the market. Instead, slow down and watch. The next candle will tell you everything. If it closes higher, buyers are building momentum. The interruption is now becoming a shift. If it stalls or pauses with wicks back down or closes red, it means that sellers held the market but buyers' challenge failed. The piercing line doesn't tell you what to do, it shows you what to pay attention to. That's a skill in itself. Look for two candles hitting the same low at the chart right now. Examine the picture closer and you might see that price is dropping, bouncing back, and then stopping at the same level again. That key level matters more than the pattern you are seeing. Think of it like you are trying to open a door. If you pull the handle once, the door stays closed. It makes sense to try again. If you pull it again and it won't open, something is clearly holding it shut. That something is buying pressure. Here's the filter. If this scenario takes place at a specific level, especially at the previous support level, it means the trend is meaningful. If it happens randomly in the middle of nowhere, ignore it. Our last pattern for part 1 is the Bullish Harami. Here's what you see. You see a large red candle followed by a small green candle that forms entirely within the body of the red one. The small candle is almost hidden inside the previous one. Once again, ask yourself, who is in control and did that change? With this pattern, the honest answer is we don't know yet. Most beginners misread this pattern as a buy signal. They see the small green candle inside the red one and assume a reversal is incoming and enter early. What you're actually seeing is sellers catching their breath. Sometimes this pause leads to a reversal, and sometimes the selling continues at the same pace. Your only job when you see this pattern is to wait for the next candle. If the next candle closes green and moves higher, it suggests that buyers have officially stepped in. So it's a clear signal to open an up or a buy trade. If the next candle is a red or barely moves, it shows that sellers are still in control. So your best move is to hold off a bit. No confirmation means no entry. That's the most important rule with the Harami. Here's how to turn all this raw information into real understanding. Open your Olymptrade chart right now. Pick one asset and scroll back 50 candles. Now go through slowly and look for any of the 5 patterns that we've just covered. When you find one, stop and ask yourself 3 things. First, what was happening before the pattern formed? Was there a clear directional pattern? Next, does the location make sense? Or is it at a meaningful level? And finally, based on these 2 things alone, would you expect the pattern to hold or fail? Then scroll forward 1 candle and see what actually happened. Do this several times to train your eye in order to examine the context. If this video made you a better chart reader, leave a like because your engagement will help more traders like you find this content. Which of these 5 patterns have you seen before but never fully understood until now? Tell me in the comments. In part 2, we are going to cover 5 more patterns, including some that consistently trap beginner traders into bad trades. I'll show you exactly why they fail and what to look out for instead. Make sure to subscribe, hit the bell so you don't miss it. Until then, stay sharp, stay smart, and I'll see you in part 2.
Olymptrade. Care that counts.